So the market today was deceptively quiet. On the surface, it looks like not much happened at all. But just underneath, there's a real battle brewing between the bulls and the bears. Let's break down all the action in the Nifty 50 and Bank Nifty for Wednesday, February 11th, and figure out who really has the upper hand. But first, as always, we have to start with the important disclaimer. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. The securities quoted are for illustration only and are not recommendatory. If you just glanced at the market today, you might just shrug. It barely budged. But was it just a calm day of consolidation? Or was it something more? Was it a really tense standoff, with both the bulls and the bears just waiting for the other side to make the first mistake? To really understand this standoff, we've got to start with the scoreboard. So let's check the closing numbers and see exactly where the battle lines were drawn today. And whoa, right off the bat, you see this fascinating split. The Nifty 50, it managed to eke out a tiny game, closing up about 18 points. But the Bank Nifty, it couldn't quite hold on, slipping 43 points into the red. This little divergence right here is our first big clue that there's way more to today's story than just a flat market. So here it is, the Nifty 50 closing at 25,953. I mean, look at that. It's practically unchanged. But that tiny little sliver of green tells you the bulls are still in there, defending their territory. And now look at the Bank Nifty closing at 60,626. That little dip, well, that confirms what we suspected. The banking sector was definitely the weak link today. Okay, now let's really dissect the Nifty 50. What is the technical chart actually telling us about this big pause in the market? Well, the technical chart is basically screaming stalemate at us. We got what's called a Doji candle, which is the classic textbook sign of indecision. It tells us that after all the buying and selling during the day, the market closed right back where it started. Neither the bulls nor the bears could land a knockout punch. The market is just pausing, taking a breath before it decides on its next big move. And that really brings us to the million-dollar question, doesn't it? With the market frozen at these levels, who is actually in control here? Is it the bulls, who've been driving this incredible rally? Or is it the bears, who are trying to stop it dead in its tracks? This just illustrates the tug-of-war perfectly. On the bullish side, the Nifty is still holding strong above its key moving averages, which is a fantastic sign for the underlying trend. But the bears have built this brick wall of resistance right at that 26,000 to 26,050 zone, and the market just can't seem to punch through it. For the bulls, everything, and I mean everything, hinges on this one number, 25,800. This is the absolute line in the sand. As long as we stay above it, the uptrend is safe. But if it breaks, that is a serious red flag, and the bears could take over in a heartbeat. But remember, the story isn't quite the same for the banks. Their underperformance today paints a slightly different, maybe a more cautious picture. Let's dive into the Bank Nifty. The Bank Nifty formed what's known as an inside bar candle. So what does that mean? It means today's entire trading range was contained within the range of the previous day. This signals a contraction in volatility. Think of it like a spring coiling up tighter and tighter. You just know it's getting ready for a big move. So the takeaway here is really clear. This quiet period in the Bank Nifty is probably the calm before the storm. This coiling price action often comes right before a sharp, decisive move. The only question is, which direction? And here are the battle lines for the banking index. The critical support is that big psychological number of 60,000, and the immediate resistance is up near 61,000. Whichever one of these levels breaks first will likely dictate the next big move for the banks. Okay, so beyond the indexes themselves, let's take a look at the specific news and stocks that were really making waves today. On the positive side of the ledger, Eicher Motors absolutely surged, up 6% after reporting fantastic earnings. Plus, there's still a lot of optimism around a potential India-US trade deal. However, this was pretty much balanced out by weakness in major IT stocks like TCS and Infosys, along with some profit-taking in PSU stocks that have just had a great run. So, what's the final verdict? Let's put all this analysis together and see what our probability model is suggesting for the next trading session. Our model for the Nifty 50 shows that the bulls, they still have a slight edge at 45%. But look how close a sideways grind is, at a very strong 40%. This tells us that while the underlying trend is positive, the market might just need more time to consolidate before making its next big move up. A significant drop seems pretty unlikely for now, with only a 15% probability. Now contrast that with the Bank Nifty. Here, the model gives the highest probability, 45%, to a sideways move. And that reflects that inside bar pattern, that coiling spring we were talking about. The bullish case is a little bit lower, but still very strong at 40%. So our final verdict is a neutral to bullish bias. It seems the market is in a time correction, just digesting its recent gains by moving sideways, rather than a price correction, which would be a sharp fall. This suggests that the underlying trend is still positive, and any dips might be seen as buying opportunities, as long as, and this is the big one, as long as the Nifty holds that critical 25,800 level. And that leaves us with the final crucial question. All this indecision, this coiling spring, it could all be resolved by the upcoming U.S. inflation data. Will that be the catalyst that finally causes the market to break out to new highs, or will it break down through that critical support? That is what everyone will be watching. Before we go, a final reminder. Investment in the securities market is subject to market risks. Read all related documents carefully before investing. The information provided here is for educational and informational purposes only and is not intended to be recommendatory or provide investment advice. Thank you for joining us.